In this video, we want to take a closer look at transactions. What kind of transactions can you make? What is that process? What does it look like? So let's first talk about what are referred to as long purchases. Long purchases is when you buy something, right? So the transactions, typically the way people think, you buy it today, you hope to sell it for a higher price later on. The objective, obviously, is that buy low, sell high process. It's the most common kind of a transaction. And of course, anything that you make returns, right? You'll receive dividends or interest as income. You'll get the difference in prices through capital gains or losses. And of course, all of that is further reduced by transactions, costs, and taxes. So let's think about how you can actually buy something. We typically think when you buy, right, you have to pay the market price. Well, that's what you do when you buy stocks. However, you have an opportunity to do what is referred to as margin trading. Margin trading means that you can borrow money from the brokerage firm to make and purchase securities. So the requirement, right, it's when they refer to your margin, they're referring to your equity. That is, how much of the investment do you own? The margin requirement is set by the Federal Reserve, and every security has a different margin requirement, if you will, or every type of security has that. And for instance, stocks is 50%. So if you want to buy stocks, you really only have to pay half price. So you pay half price, you borrow the other. So the idea of margin trading is to utilize some financial leverage, right? Financial leverage is the use of debt financing to magnify investment returns. So again, this margin loan, that's how much you owe. And of course, since it is a loan, you will have to make payment as far as interest is concerned. So let's look at what happens when we trade. So we buy 50 shares of stock. The number is $50 and we buy 100 shares. So the cost is $5,000. If you don't borrow money, that means you invested $5,000. If the value goes to $8,000, you obviously made $3,000 in capital gains. That's a 60% increase. And of course, if the value went to $2,000, you would have earned a 60% loss. Now, what happens if we can borrow? And let's just look at the 50% because that's where we started this. So if you invest, again, the value when you invested was $5,000, but you borrowed $2,500. So your primary investment is $2,500. So the value of the stock, if it goes to $8,000, you made $3,000 in profit, but you only invested $2,500. So the return on that profit then is 120%. And of course, if it went to $2,000, you get the exact same return, but in this case, it's negative. So what you can see is by using margin, we can increase the returns that you potentially could make on your investments. So again, let's kind of think about why is this margin trading important? You can magnify return. It allows you to spread your money out a little bit so you can get some better diversification, if you will. The disadvantage is obviously if it magnifies returns, it also magnifies losses. And of course, now there's a cost of the margin loan. So now you have to make profit, but now not just to cover transactions costs, but now you also have to make a margin payment or an interest payment on the margin. Usually the rate on this is 1 to 3% above the prime. So if the prime rate is around 3 or 4%, you're going to pay somewhere between 4 and 7% interest on this. There is a video, again, I just haven't decided. It's a site that you can go to. If you notice, it's FINRA, And you can go to that site, and it has information about margin trading. Again, if you have an interest in gathering a little bit more information, this self-regulating organization provides some great information. So let's continue our talk about these margin transactions. So a margin account basically says you have an account that allows this borrowing to happen. So typically you have to have a minimum amount of money to invest in here, right? And of course you have to have some dollar, some cash invested in the account. The initial margin, that's the minimum amount of equity that must be provided by the investor. And again, I've already mentioned different kinds of securities have different governmental set margin accounts. Now, the brokerage firm can also set a margin, but of course it can't be any different, it can't be any lower than what the federal government allows. So the federal government says you have to own at least 50% of the asset. The brokerage account can look at you and say, yeah, well, we want you to own at least 75%, which means you can only borrow 25% of the money. Again, you still get magnification, but maybe because of your financial status or the riskiness of the investment, maybe they can change that margin agreement. So a restricted account is an account that has equity that's less than the initial margin requirement. So you're supposed to have 50% in there, but because the market's declined, you only have 40%. Now that doesn't say anything bad necessarily, other than you now have an account that's been restricted, right? So it might limit the things you could do with that particular investment. Now the maintenance margin is the absolute minimum that you can maintain to keep the account viable and running. If you fall below this, let's say that the margin account, or the initial account's 50 and the maintenance account's 25. If it falls below 25%, you get what's referred to as a margin call. You have to provide funds, assets, to bring this account back up to a minimum of what the maintenance margin is. If you don't have the funds to put into this account, what they will do is they will sell off assets to bring that account back into balance. And of course, the debit balance is the amount that you've borrowed, and that's the amount, that's how we calculate the interest on the loan itself. So let's look at some formulas here, right? The basic margin formula is you take the value of the securities minus the debit balance, and you divide it by the value of the securities. So this is how you calculate margin. So an asset that has a value of $3,500, we purchased the asset when it cost $2,400 at a 50% margin, and we've received $500 in dividends. Now we'll look at both these assets in a second. The other asset has a value of $3,000. It was purchased for $2,000 on a 50% margin, and we've received $1,000 in dividends. So let's first look at what is the margin on this account. $3,500 minus the $1,200, because we bought it at $24 for a 50% margin, so we only invested $1,200, or this is the debit balance. So that means that this account currently has a 65% margin. And asset B, again, it was $2,000. 50% margin means we only invest, the debit part is $1,000. So that means that 66.67% is the margin. So we can calculate the margins fairly easily. But now we want to ultimately calculate what's referred to as the return on invested capital. So to calculate this, we need to know what income has been received, what interest has been paid, what's the current value minus the beginning value. We then divide that by the equity in which you invested. So let's look at this. So without a margin purchase for asset A, if we hadn't bought on margin, again, $2,400 is the cost. We received $500, it's worth $3,500. $2,400 was the cost, so we earned 66.7% is the return we earned on this investment. With a margin purchase, because we invested at 50%, we only had to put up 50%, we actually earned 133.33%. Asset B, again, $2,000 is what we invested without a margin. We earned 100% on our asset. With a margin, since we only invested half of the money, right? Equity was 50% margin. That's 200%. So we'll have another example here in a second, but I just want to kind of go through very quickly and show you how the process works. One final thing before we look at a little bit more, another example, is the margin requirements for different types of investments. So again, stocks, etc., it's 50%. Most everything's 50%. Corporate bonds, 30%. So that means you only have to put up 30% of the money. For government things, you only need 10% of the principal. Agencies, it's 24%. So think about this. So United States government bills and bonds, which by the way, are guaranteed, are risk-free, you only have to invest 10% of the principal in order to get the benefit of the growth of those assets. Options, again, option premium plus 20% of the market value of the underlying stock. So again, it's a little bit of a more complicated formula. But look at futures. There are futures that you only have to put up 2% of the value of the contract. Now, if you just think about percentages, I mean, 2% is very low. But some of these contracts can be huge as far as the value of the contract itself. But again, with these margin requirements, you can really leverage up some of the returns that are possible with some investments. So again, why would we want to use margin trading? We want to magnify returns. Your book talks about this process called pyramiding. This basically says, look, if the prices are going up, then these paper profits, right, you can use that to finance the acquisition of other securities, right? So this is kind of, in essence, like using the equity in your home to buy more stocks or to buy more house, if you will. So excess margin means you have more equity than what's required. Now, again, there are some constraints, right? If you're buying more securities with this margin account, right, you still have to be above that initial margin level. And of course, the risk associated with price declines is always present. So again, there's some great uses of the margin account. And again, for an individual starting out, this might be the way that you can help diversify some of your investments as you're moving forward. Now, I will tell you, with mutual funds, the challenge with the mutual fund is mutual funds cannot be purchased on margin. So you have to pay the value of the margin account, of the mutual fund, excuse me. But typically, the value of a share of a mutual fund is very low. So yeah, we'll talk about that again in maybe a later video. So let's look at a final example here. And now we're going to utilize a spreadsheet to help us. The purchase price of the stock was $10,000. I was originally given a 70% margin option with a 40% maintenance margin. I've held the security for 1.5 years. It's given me $600 in dividends. I paid $375 in interest. So given this information, what can we tell about this investment? And we're going to look at some different scenarios. So in the first scenario, I bought it at $10,000 and now the value is $15,000. So let's look at what the information we have on the right. The first things we see here is what is the initial debit and equity portion. If you remember, it's a 70% initial margin. So that means I gave them $7,000 and I borrowed $3,000. The maintenance margin is 40%, which means the maintenance margin balance, right, is $6,000. If it falls below $6,000, now we have a problem with potential margin calls. Here we also include the interest we paid, the cash flow received, and we also have the holding period, which I told you was 1.5 years. So let's again further. The return on invested capital, just the straight out calculation that we had before, said that this was a 74.64% return. However, that previous return on invested capital formula is only good for a 1 period investment. In this case, let's just say it's a 1 year investment. What happens if the investment period is different than a year? In this case, we say, look, it actually took 1.5 years, and then there was something happened to this thing. Maybe I sold it at the end for $15,000. So now we have two return on invested capital calculations. One is going to be referred to as the approximate, and the other is the time value formula. So the time value formula is going to give us the exact number. That's 45.022%. The annualized, the approximation is 49.762%. So you see there's some time to time, there'll be some big differences between the two. The actual return, if you didn't calculate margin, right, is 52.25%. If there's no margin, you made 52. With margin, 74. The current margin on this account is 80%. Can you know that's obviously more than the initial margin, right? So that means you own more, right? So we have this equity balance, right, that maybe we could trade on. And then down here below it says, look, the amount required for margin call, it's negative. So if this number is negative, it means there's no margin call required. So let's look at what happens if the price moves the other direction. Now it went down. Again, we still have our original numbers up here, but what now has happened is, obviously, we've turned negative. And again, you can see what's happened to the returns. The return without margin was -17. Again, with the margin up here, you see that some of it is a little, we're in the ballpark. But the return on invested capital, without these two numbers, you can compare the 25% to the 17%. That tells us what happens when you magnify returns. Again, you can see we're at 62%. We know the maintenance margin is 40%. So we're still good. We're below the initial margin, but we haven't gone below the 40% number. In this case, again, you still see the margin call, $1,800 there, which means there's no margin call. Now, what if it goes clear to $4,000? Down below, you see the margin at $4,000 is now 25%. That needs to be above 40%. So there'll be a margin call. So they'll ask us to give them $600. So either we'll put $600 in the account, and that'll bring it up to 25%, or they will sell off $600 worth of this asset to bring it into compliance. So that's the basics of margin calls and buying in what's referred to as a long position. There is another way to make money though, and this is what's referred to as short selling. Short selling is the practice of selling borrowed securities, right? So you're going to borrow a security from a broker. The broker lends securities, quite frankly, they're owned by other investors that are held in what's called street name. Now the investor, you have to make a deposit right, that's applied to the short sale proceeds, right? So it's kind of like there still is an equity requirement. In this case, what you're doing is you're doing the trading backwards. The objective here is to sell high, and then later when the price goes down, you buy low, buy the stock, and then return it back to the brokerage house. So this is how investors can make money when stock prices go down. So here's how it works, right? You borrowed some shares, you sold it today for $5,000, you bought it back later for $3,000, which means you have a net profit of $2,000. That's the mechanics. How it actually works, right? The price per share is $50. On the initial short sale, $5,000 is the short sale, 100 shares at $50. We're going to have to make an initial deposit. 50% is the equity, so we'll have to deposit $2,500. So the total deposit with the broker, right, is $7,500. The cost of buying back the stock, $500, right? So the account equity, right, is 50%, right? So it's number 4, right? Divide minus number 5 gives us $2,500. That means it's 50%. 25% of 5,000. 50% is the actual margin. And again, if the maintenance margin in this case it's 30%, we're still okay. What happens if the stock price goes down? Well, that's what we want to happen. In this case, we'll make money because the stock price goes down. If it went down to $30, we would then buy the stock for $30 and give the stock back, which would also turn off the interest. And of course, if the stock goes the wrong way, there's potential margin calls. So this, again, if we make short sales, we really want to be diligent about stocks moving in the wrong direction. That is, if the price goes up instead of down, that's a problem for us, and we really want to look at it. The advantage, you get an opportunity when, if you think stock prices are going to fall for a company, it's an opportunity to make money when prices are falling. There's limited return opportunities, right? The stock price can't go below 0. There's unlimited risks, though, because the stock price can go up an unlimited amount. If the stock price goes up, short seller needs to buy shares to pay back the borrowed shares, right? It's at a higher price. The other challenge we have is that short sellers don't earn dividend income. In fact, they have to pay dividend income to the lender because they think they own the stock. They require the dividend to be paid to them. So again, there's some little strange things that go on with short sales, but in general, it's just an opportunity to make money moving in both directions. So that's the end of our discussion about transactions.